What is the most concerning aspect of the latest inflation report? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial. In this Econ Market Minute, I'll give you 3 highlights of the past week and 3 potential market movers for the week ahead. So let's start with 3 highlights from this past week. First, small business hiring plans are important for markets, and right now, hiring plans are slowing as overall business expectations deteriorated. A big risk we learned here is that businesses may have a harder time passing along higher input costs now. Earning trends appear under pressure as we move into the third quarter, which will likely be a drag on the markets. As businesses and consumers become more pessimistic about the future, the Fed will likely reevaluate the intensity of the balance sheet rundown, something that is not as talked about right now since the media tends to focus on the Fed funds target rate. Overall, the probability of a soft landing is getting smaller and smaller, especially if the Fed becomes too aggressive later this month. Second, June headline CPI rose 9.1% from a year ago. Key drivers, the large increase in energy prices last month and an increase in transportation costs. By the way, June gas prices were up 60% from a year ago, 11% month on month. Excluding food and energy, CPI rose 5.9% year over year, slightly slower clip from May. The most concerning component is rents. Housing prices are very sticky, meaning prices don't adjust as frequently as other items. Rents have increased each month since April of last year. Most recently, rents are up 5.8%, the fastest increase since the mid-'80s. A key takeaway is inflation is becoming entrenched, exactly what investors and central bankers worry about the most. The Fed will likely hike rates 75 basis points later this month, if not more. The inflation debate will likely include the conflicting data on raw industrial and food prices. For example, copper prices steadily declined from April's peak, showing that some input prices have softened in recent weeks. Investors have to wait and see how the change in input prices will eventually filter through to consumer prices. Unfortunately, the Fed does not have time to wait and see. The strong dollar may also be a concern for the Fed as they continue on this more aggressive tightening schedule compared to other central banks. Third, nominal retail sales rose 1% in June. Spending was broad-based, not just boosted by more money spent on gasoline. The report was not all rosy. The decline in department store sales may suggest that consumers are spending less at name brand places and going over to discount retailers, as we have recently heard that major discount chains are expecting accelerating growth. Given this report, the U.S. may actually post flat to positive growth for Q2 and avoid 2 consecutive quarters of negative growth. The Fed could try to use this data to support larger than expected hikes later this month, but right now, the Fed is focused on the data. If the consumer is stable enough, the Fed could indeed implement a large hike without breaking the economy. So how about 3 potential market movers as we preview the week ahead? First, investors will get an updated look at housing statistics from insights from the National Association of Home Builders. This is the survey data. We'll also get hard data from existing home sales. Home builders tell us about prospective buyers' traffic, a great leading indicator of future housing activity. Look here for beginning signs of any crumbling of the housing market. Yes, the market is dramatically slowing, and these data from home builders give us an inside look if there are risks that housing could come to a screeching halt. Second, some investors will focus on building permits and housing starts, and the markets could get spooked on any outsized change in these leading indicators, especially building permits. At this point, home inventories are low, demographics are supportive of the housing market, and mortgage rates have been fairly range-bound since early June. Third, the Conference Board will release leading economic indicator index. And again, Markets will look closely here to see if the economic slowdown is accelerating or is it measured, like we saw in the recent labor market statistics. At this point, investors are conflicted about the depth and duration of an upcoming recession, so any piece of information that surprises to the downside will add volatility to the markets. That's all for now. See you next time for more economic insights for your week, and be sure to follow me and the rest of the LPL research team on social media for regular global market updates.